All right, we're back with another episode of the Mortgage Show. Beds, what do you got on your head right now?
CMG Home Loans, baby.
Let's go. The hats are in. If you're
Yeah,
watching this,
dude, they're looking sharp. Sorry to cut you off. What do you think? Do you like them?
I love them, dude. I love the colors. You know, it's like a different kind of blue than our Norcom hats. The CMG logo is looking big, sticks out. Got a lot of compliments on it. So I assume you're doing the same thing as me. We're just handing those things out whenever we have an opportunity to. So if you're listening to this podcast and you want one, chances are we want to get you one anyways, but let us know and we'll get you one.
What's the process for you when you've got a couple and that you're going to give them to a person? Are you screening the fact that it's like, all right, I'm going to meet this person. Are they going to be around somebody else that I maybe might feel obligated to give a hat to?
I've had a couple of those, and I thought, oh, should I get one? Should I get one too for that person, or should I just hold off altogether? So I don't know. It's a game time decision for me. I think more hats out there is better than less hats. We definitely have plenty of them to hand out, but I'm still kind of at the point where they're like prized possessions, and I want to make sure that the people that I want get them.
Yeah.
If that makes any sense.
Oh, it definitely does. I got the Legacies the other day at the field hockey game. Mm-hmm. Your boy Jay Gay was there.
Did you give him one?
I had to give him one.
Okay, good, because I was going to give him one anyway. So anyways, yeah, there's a bunch of people on our list to get hats. So if you want one, definitely reach out to us. I always have a sleeve in my Jeep. You, I assume, have a sleeve all the time with you.
Yeah.
So we're getting these things out there. And if you wear one, throw a little selfie on Instagram. Tag us. I want to see if you're liking them or wearing them. So, okay, we did a little Facebook Live the other day, which was kind of fun. Yeah. Took like freaking what felt like 30 minutes for it to go from the time I hit record to the time that you joined. It's like a ton of dead space at the beginning, but it's cool. A bunch of people watched it. Bunch of comments. I think people liked it. So I think we'll probably try to do like a quick Facebook Live here and there when there's something worth talking about. And the thing that was worth talking about last week was the Fed cutting interest rates, or the federal funds rate, by 0.5%, or 50 basis points, I should say.
Yep.
That was big news then. It continues to be big news. Do you want to rehash that?
Leading up to this question, I was like, one of the things that I wanted to describe is I would say the 2.5 months leading up to this decision, you could see the trading of mortgage-backed securities leaning in the area of at least knowing that 50 basis points was coming. So it was almost like the mortgage rate relief was already in the pricing by the time the decision was made. So it's like, I don't know. What do you think about the reaction after the fact when it comes to the mortgage-backed securities? It wasn't maybe what the news made it seem like with mortgage rates.
The rates did not improve when this happened, and it's because of what you were talking about with the market kind of expecting that it was going to happen. So I don't think rates are much better today, maybe slightly worse than what they were last week. But I think that's to be expected. You know, so I know that projections say that the Federal Reserve is expected to cut rates by another 75 basis points by the end of 2024 and up to 200 basis points by the end of 2025. So I'm interested to see how those expectations start to play into things with some of the inflation readings that we're going to get, the job reports that we're going to get, because if those things are favorable and that's what people expect are going to happen, then I think rates could continue to come down even further. They just haven't yet in the 2 or 3 days since we saw them cut the rate.
I'm looking at the chart right now without boring people about my mortgage-backed securities, my green and red candles. It's been since the beginning of July to this conversation today that we've steadily climbed up the chart. We're above all of these moving averages, the 25-day, the 50-day, the 100-day, the ever-important 200-day moving average. So when the trading is above those floors, that's some of the lowest interest rates you're going to get. So what's going to push it further from here? Like, we need a run of like less than economic news. Yes, it's nice inflation's tame. Yes, it's cool that the Fed lowered the Fed funds rate. But what's going to drive it from here? It's economic news. And we're sort of in this tight trading range where it's like, we're just going to go back and forth a little bit from here as far as like probably pricing better an eighth one day, maybe losing an eighth the next. So I don't know.
And one thing before we move on from this, because again, if you want to hear us talk about it, the Facebook Live is on my Facebook page. The Federal Reserve did not cut mortgage rates last week. And that's a common misconception that we see all the time with people. What they cut was the Fed funds rate. It's the rate that banks borrow money between each other. And that obviously has an impact on things in general, but it doesn't have impact on things in the moment. So they did not cut mortgage rates. they cut that federal funds rate, and the market, like you just said, for the 2.5 months leading up to last week had anticipated that. So they already had dropped. So sometimes people are like, hey, should I wait to lock until the day after the Federal Reserve meets because they think that rates are going to be that much lower? Just to be clear, it doesn't work that way, and it will not work that way moving forward. The next time we think rates are going to drop or the Federal Reserve is going to cut rates, the mortgage rates will have already kind of priced that in. So I think it's just important to say that.
When I ramble about this topic, I'm always reprimanding myself to kind of keep it short, maybe dumb it down a little bit. But of importance is when inflation is tame, when economic news starts to stagnate, you need to know that that's good news for mortgage interest rates. That's the organic progression. Inflation's tame, Fed fund rates coming down. All right, that's cool. But also economic news continues to sort of be stale.
Like job reports, manufacturing reports, like things like that. If those things come in a way that is bad for the economy or represents an economy that's not running as efficiently or as hot as that people would expect, that's going to mean rates are going to come down as well.
The theory is when things are so on fire, you need to curb that. So you raise interest rates, inflation's up, you raise interest rates. Now we're on the opposite side of it. So, Randy, we're about to have a big run here, buddy.
Let's go. I love it. So the thing we want to talk a lot about refinancing today, because I think what this rate scenario is going to do is going to create a lot of refinance opportunity for people that we helped buy homes in the past 18 to 24 months. The people that want to buy homes are going to continue to want to buy homes. Rates will be better for them, so that's going to work out pretty well. This might increase the demand of people that want to buy homes that were kind of sitting on the sidelines when rates were at 8%. But I think that stuff is there. It's going to be there. But we wanted to talk a little bit about refinance programs out there, some considerations to keep in mind. So before I get to that, we actually had some news today that I was talking to you about offline that I think is worth sharing. Every time we talk to a customer, we run their credit, because that's a big part of qualifying for a mortgage, obviously. That inquiry into their credit triggers a notice, and that information gets sold to other lenders and banks. And that's why when we run someone's credit, they start getting a bunch of phone calls, emails, things in the mail. We just got an article shared with us today that there's a bill in the Senate that would restrict trigger leads, which I think is huge for our business. And we might as well mention it for any realtors that are listening or any potential borrowers, that when you get a bunch of calls after we run your credit, it's not because we're selling that information. It's the credit bureaus that we run it through that are selling that information. And it's annoying. It's frustrating, creates scam opportunities. And I was excited to hear that might be limited. I'm sure you are too.
It's pretty nice. I think CMG does a really good job too. It's like when we have somebody in the nest, they apply, they start getting stuff from our CRM. One of the first things that we trigger to them is like, hey, look, you're probably going to get a call from somebody else. It's a trigger lead. Here's how you opt out of this. So I think we do a good job of jumping ahead of it. But if we could eliminate it altogether, I'm for it. It's just such a weird way to do business, isn't it?
We do not do business that way. Like you and I do not like buy trigger leads. I actually don't even know anyone that does. I think it's more for like call center type lenders or internet only lenders or something along those lines. But like people like us do not buy trigger leads. So when someone's credit gets pulled, we're not buying that information so we can reach out and try to steal that from whoever they're working with. We build our relationships through referral partners and, networking and past clients and people we know and stuff like that. So we are not buying these trigger leads. I'll be happy when they're gone, if they're gone.
Dude, isn't it such an important thing to you to have a relationship? It's so weird not to get like super weird on like relationship stuff with clients, but it's like I have zero motivation to just call leads and say, hey, or give the perception that I have the lowest rate, the best product, all of this stuff. Like I want somebody feeling comfortable that they're getting into something with me and that I'm going to finish it for them. It just seems so weird to start a quote unquote relationship with somebody off of a trigger lead. Hey, I'm the greatest ever. Go with me.
Yeah. Forget those people. Out of here. Boom. See ya.
See ya.
Thanks for coming. Couldn't agree more. So, few different loan products that we want to talk about just to kind of refresh the memory of, again, realtors, referral partners that might be listening, people that are borrowers of ours that may be listening. Why don't you start with a couple of like the Streamline-ish type programs that we talked about? Pick whatever one you want to start with.
I guess going under the government bracket, you have interest rate reduction loans on VA loans. FHA has a Streamline. RD has a version of it also. And I guess what's nice about government bracket is that if your credit score is above certain criteria, you've paid your mortgage on time. VA has like a 6-month payment minimum before you can refinance, and I think it's half a point. But it's really nice where we don't have to credit qualify somebody. We just go on the fact that their credit scores meets the minimum and they pay their bills on time, which means the mortgage is paid on time. So that's nice.
It does not matter if they don't have a job. Like if they are currently unemployed, again, like Chris said, if you pay your mortgage on time, your credit score is above the minimum, you've had these loans for a certain period of time, you qualify. And it's a great way to reduce someone's payment. The thing, and I'll just say full disclosure, the thing that's tricky about those type of streamline options, and I'm sure you'll agree with me, is that normally we'd try to build in the closing costs to the loan amount, like meaning like we would increase your loan amount by a couple $1,000 to cover those costs. With these streamline options, you can only refinance the existing loan amount, which means that you have to have the ability to pay the actual closing costs out of pocket.
Yeah. So we make those work trying to obtain a closing cost credit for a borrower to help out. We typically try to time these closings where instead of making a mortgage payment, you bring your payment to the closing, which typically will satisfy the amount that you need in your new mortgage for your escrow. So there's ways to sort of position it, but yeah, good job with that.
To minimize it, but it is a little bit of a different thing. Beyond that, like a lot of people are trying to get out of the government loans and go to what's called conventional financing. Like a lot of times people do VA loans excluded. There's no PMI, but if you're listening to this, you probably are familiar with PMI, but FHA loans, RD loans, those have PMI for the life of the loan. A lot of times people are trying to refinance out of PMI because they've owned their home for long enough that they have the necessary equity to do that. So with a conventional refinance, you do need to get an appraisal. We do need to credit qualify you, but if your credit's good, income works, that's probably where you would want to be, at least at this point. I know that's certainly what I'm doing with a lot of people right now.
It's nice on the conventional side. You want to transition to conventional?
Yeah, let's do it.
I like the fact that I always use the term crooked terms. So I like to try to find a benefit on the conventional side where if you've been paying in your mortgage for 3 or 4 years, what does the payment look like if I wrote a 26-year term at the reduced interest rate to keep you on your same term pace? So that's where I start typically. But what if you like your payment now, you're used to your payment? What does it look like if I chop off another 5 years of that term so you land in the same payment scenario that you have now? So it's almost menu option when we look at conventional scenarios like that. I'm sure you do that.
100%. If you have 26 years left on your mortgage, going back to 30 you could do it if the number one priority is just saving money on a monthly basis, and you don't care about anything other than instead of having X mortgage payment, you have X minus $500. Like you would achieve that by having a lower interest rate and then going back out to 30 years, but you are setting yourself up to pay a lot more interest in the long run. So trying to keep that same term is, I think, something that a lot of people probably breeze over. And then, like you said, if you're comfortable with that payment and you don't necessarily care if you're saving money per month, you just want to chop years off the back end, then you just lower the term and make something work that fits that mortgage payment. So it's nice that we have the ability to do any of those things. I think that speaks to the consultative approach that we have with people.
Good use of consultative.
Yeah, I just kind of been working. I've been waiting for the opportunity to throw that in there for a few months now. So it's nice to finally get that out there.
Man, if we did an appraisal on your vernacular, man, it's like,
hey, nice use of vernacular.
Thank you. Thank you.
All right, a couple other things. Regardless of rates coming down,
yep,
it's not going to make sense for people to refinance, even if rates are in the upper 5s or 6%, if they are sitting on a 2.5% interest rate or a 3% interest rate, right? I mean, there's maybe some unique situations that would apply, but in general, like I'm not going to advocate for someone that has a 3% mortgage to do our new refinance to a 6% rate unless there's some very specific reason that I can't even place right now. Maybe there was some debt consolidation that was at a way higher rate and you were trying to find some middle ground. Outside of that, you're probably going to keep those people's first mortgage in place and look to tap into some of that home equity through a second mortgage. Would you agree?
I would agree. The only time that I'm noticing that somebody is going to vacate a first with an interest rate that low is that with the back end of their debt, the consumer debt they have, maybe they have a second mortgage with a high interest rate. So maybe the compromise is vacating that first lower interest rate mortgage to sort of create some monthly liquidity in the overall budget. That would be the only case for it. So that can't be overlooked. But in a lot of cases, to your point, leave that first mortgage where it is, look at a fixed second mortgage or look at a home equity line of credit. So
tell me what you think about this, but I feel like a lot of people use the word HELOC, not necessarily knowing what it means. Like they're like, oh yeah, I should get a HELOC, but what they really might be meaning is they should get a fixed second as opposed to a HELOC. So I was hoping to run through the difference between those two things if you want. I don't know if you want to take it or you want me to go.
Could I do the HELOC? So
Sure.
HELOC. So the last couple of years of people have been sitting in these cushy first mortgages, wanting to tap into equity. They got a HELOC, which was tied to prime. Okay. So whatever prime went up, that HELOC went up, that interest rate went up. And it's a simple interest calculation. It's mortgage balance times rate divided by 12. That's your payment. We're on the better side of HELOC scenarios now since they are not fixed and that it looks like prime's going to be going down from here. So hopping in a HELOC is not a bad idea if you don't want to vacate the first. So go ahead.
I was going to say, I agree, because it is this weird thing. The way I used to explain it or outline it for people is like a home equity loan is where you get a specific dollar amount at a specific rate for a specific amount of time. Where the HELOC is you basically open up a credit card against your equity, but you're not necessarily borrowing the money up front. You're borrowing it at some point in the future as needed, any amount of that line. And then the rate's variable. Like I used in my mind, it was always, if you know what you need the money for, if it's for debt consolidation, paying for a wedding, doing an addition or renovation that you know the specific cost, the home equity loan makes the most sense because you need the money right away. You're fixing the term, you're fixing the payment, that's all set. And the home equity line of credit was more if it was emergency fund type stuff. You just wanted to have the money just in case. You wanted to have the money available just in case you wanted to buy a piece of real estate, do a flip, buy an investment property on a whim, you would have access to it. So it was kind of like, what was the money being used for? Then that would kind of point me in either direction. But the HELOC is becoming a little bit more attractive in my eyes, knowing that rates are going to be coming down. Because once you lock in that higher home equity loan and rates continue to come down, like that's the rate that you have. Where with the line of credit, that is going to go down as the federal funds rate goes down over the next 18 months.
Nice. I felt like I was just listening to 99 Pedro right there. You just dominated that. You just dominated that. I think though, one of the things that would be so cool is if we could, I feel like I'm striking out right now, but the all-in-one loan as far as the equity and being able to tap into it, I really hope that I can start moving that loan a little bit more. That's such a great option for people looking to use equity in the future and pay down their mortgage quicker.
Dude, we could do a whole podcast on the all-in-one loan, and maybe we should in the months to come, because that's a whole other product that has some really good use cases and can really minimize the interest that people pay over the life of their loan. So that's a unique CMG product, something that me and Beds will tell you about at some point in the future. But if even those words all-in-one sound interesting and you want to chat about it, definitely reach out. Speaking of CMG specific, I guess, programs or products, one thing I've been talking a lot about with these rates coming down right now is the rate rebound. Have you been having a lot of conversations with people about that?
Yeah, it's a great product.
I mean, it's I don't even know how to describe it, if it's a product or a program, but basically the gist of it is that if CMG, and we've talked about this in the past on podcasts, but I think it's important to remind people about this because it is a differentiating factor for CMG. But when CMG does someone's purchase loan, they will allow them to refinance after 6 months, up to 5 years, an unlimited amount of time, waiving all lender fees and giving $1,000 credit towards third-party fees. All right.
Yes.
So, what do lender fees look like? Probably like $1,400 worth of underwriting fees, origination fees to CMG, and an appraisal. Boom, those things are gone. Probably equates to around $2,000 gone right off the bat.
Yep.
Then you add another $1,000 to that. That can cover your attorney fees, title insurance, depending on the loan amount. It might cover all of your actual closing costs to close, and on bigger loan amounts, it might cover a good majority with just a little bit left over. But I don't know that there's other companies out there that offer anything like a rate rebound where it's just kind of baked into things right from the beginning. You do a purchase with us, you get basically what equates to a free refinance, although it's not technically free.
The trick of the trade, and I've been doing this for 20 years, is that when you look to refinance somebody at a certain part, at any time throughout the course of the day, an interest rate available pays a certain profit. And I guess what we used to do is take that interest rate, bump it up a quarter, additional profit. We'd give it to you as a closing cost credit. The difference with our CMG platform in this program is there's no bump to interest rate. There's actually, as a loan officer, our commission is carved up. We gave the credit through CMG by waiving all the fees that typically make us profitable. It's definitely something where you're going to get a floor interest rate. We want to retain you as a customer. It's a really huge selling tool. And it's, as I talk about it, it's like I never want to confuse people with what we've done from the past, but this is just best case
really,
scenario. Yeah.
I want to be clear. I do think this is a huge differentiating thing, because if you have us at CMG offering X rate and you're going to your bank and they're offering the exact same rate, like the fact that we have this rate rebound program is a reason to work with us at CMG. It is something that we expect rates are going to come down. We expect you're going to refinance. It makes a ton of sense to like put some weight into that, because it is going to save you thousands of dollars when that time comes.
Yeah, we want to retain you.
Yeah. So again, just to be clear about what you said too, it's not a higher rate because of this. It's still like that great low rate that we can offer at CMG. It's essentially, it's us as loan officers paying for it. Like you said, our commissions are carved up. So less money for us means we're passing that along to you as the borrower. So you have less costs when you refinance, because we want to retain your business. So keep that in mind if you're purchasing with us or you're kind of considering us versus someone else. It's a great benefit that we have at CMG.
Love it.
Anything else, Beds? I mean, I think that's everything I wanted to hit this week, or this month, I should say.
I think that's good, man.
Okay. Well, listen, thank you guys for listening. Any referral partners, borrowers that we have, customers, appreciate taking the time to listen to what we had to say. If there's anything that me or Chris can do to help, please reach out. We're happy to do whatever we can.
As always, thanks for listening. We love it.
All right. See you guys. Have a good month.